Welcome to the deep dive. You, our listener, are joining us today because, well, you probably recognize that financial markets often have this frustrating paradox going on.
Yeah, things look great on the surface. Headlines are positive, markets are up.
Right up until they suddenly aren't. And that's what we're digging into today.
We're cracking open the big one, the International Monetary Funds, the IMF's Global Financial Stability Report for 2025.
And the title they chose this year, it really says it all, doesn't it?
It absolutely does. Shifting ground beneath the calm. Perfect.
Because if you just glance at the news equity markets hitting records, borrowing costs for companies seem pretty tight, manageable.
And liquidity feels like it's everywhere. You'd think, okay, everything's rock solid.
Exactly. The calm feels almost, I don't know, too calm. But the IMF, they're basically ringing this huge alarm bell.
They are. They're arguing that underneath this shiny surface, these quiet vulnerabilities are building up.
And that's keeping global financial stability risks. Well, the word they use is elevated, stubbornly elevated.
And it's not just talk. They put a number on it. They use their metric, the growth at risk measure.
Right. That looks at the downside risk to global growth.
Exactly. And that risk, it's stuck around the 30th historical percentile, which, sounds technical, but it means.
It means the danger of a really significant economic downturn is still way higher than you'd think, given the market mood.
Precisely. We're navigating this market that feels calm, but, well, structurally, it's still pretty fragile.
So that structural fragility, that's what we're here to map out for you today.
Our mission for this deep dive is really to unpack the GFSR, get into the specifics of what's creating this hidden stress, the shifting ground.
How all these different pressures are connected, potentially in a really scary feedback loop.
And crucially, what the IMF thinks policymakers need to do, like right now, to stabilize things before these hairline cracks turn into something much worse.
Okay, so where do we start? Why does the market feel so calm if the risks are building?
Well, the IMF kind of nails it with one phrase. The entire system is basically priced for perfection.
Priced for perfection. That really captures the mood, doesn't it? I remember back in April 2025, that tariff sell-off.
Oh, yeah, that felt like real panic for a minute. Conditions tightened up fast.
But then, almost just as fast, the market did this complete turnaround. Conditions eased right back.
Right back to accommodative levels. And, that quick recovery, it didn't actually fix the underlying issues?
No, it just seemed to encourage this massive wave of complacency.
Yeah, this feeling that, oh, don't worry, the central banks or governments will always swoop in and save the day.
And you see that complacency reflected in the prices,
Yeah.
right? Especially equities.
Vividly, particularly U.S. equities. The IMF's own models, they suggest the S&P 500's forward price-to-earnings ratio. Well, it's climbed way back up.
How high are we talking?
We're talking about the 96th historical percentile since 1990.
96th percentile. Wow. That's really up there.
It's staggering. I mean, think about it. You're basically in the top 4% of how stretch valuations have ever been over the last, 35 years?
Yeah, you only need to look back at times like the late 90s tech bubble, or maybe just before the pandemic hit.
Right. To see how little room for error, how little room for disappointment the market is pricing in right now.
It's priced for perfection.
Exactly. And the risk isn't just how high valuations are, it's how incredibly concentrated the market is.
Ah, the concentration risk. That's at historic highs too, isn't it?
It really is. We're talking, of course, about the Magnificent Seven, the M7 stocks, and that whole AI narrative.
That handful of huge tech and AI companies.
Just 7 of them. They now account for, get this, 1/3, 33% of the entire S&P 500 index market cap.
1/3 from 7 companies. That's just wild.
Think about the implications. The performance of a massive chunk of the world's most important stock index basically hangs on whether these 7 companies can keep delivering on these, frankly, stratospheric growth expectations.
Expectations that seem priced in for like decades to come.
Right. And if just 1 or 2 of them stumble, maybe regulators crack down, maybe geopolitical tensions mess up their supply chains, maybe the huge AI investments just don't pay off as quickly as people hope.
Then the whole index, the broader market, is incredibly vulnerable.
Yeah, vulnerable to a sudden, sharp correction, a correction that would ripple out globally.
Okay, so on one side, you've got private money chasing these super concentrated, arguably super risky tech bets. And on the other side, you've got the old problem, but maybe feeling more dangerous now. Government debt.
Sovereign debt.
Absolutely. It feels particularly acute now. The IMF is pointing out that Many advanced economies, the ones with the biggest economies and the most debt already, they just haven't put forward credible plans.
Credible plans to actually stabilize their debt, get it under control over the medium term.
Exactly. And this isn't some abstract problem for the future. It's happening now. High debt, plus these delays in actually making tough fiscal choices.
It's pushing up long-term borrowing costs today. It's actively exerting upward pressure on long-term bond yields. Which brings us to this technical thing that's suddenly everywhere, term premia.
Right, term premia. Used to be just for bond geeks, now it's front page news. Explain that simply.
Okay, so term premium is basically the extra compensation investors demand to hold a long-term bond, say a 10-year treasury, instead of just buying a short-term T-bill and rolling it over.
So it pays you for locking your money up longer.
Yeah.
And for risks like inflation.
Exactly. Inflation risk, liquidity risk. But increasingly, the IMF says it's fiscal risk, the risk that the government's finances aren't sustainable.
So the market is looking at government budget deficits.
Yeah, the GFSR analysis is pretty blunt. They found a really strong link, a co-movement between term premia and the projected average budget balances over the next 5 years.
No, if I'm an investor and I look at a country and I see forecasts for big deficits stretching out for years with no real plan to fix it,
you demand a higher term premium now. You're essentially saying, look, your borrowing trajectory looks risky, maybe riskier than your official credit rating suggests, and I need to be paid more for taking on that policy uncertainty.
Okay, and the big implication here is?
The implication is that we might be entering an era where a permanently higher level of term premia is just a feature of the market.
Meaning borrowing becomes structurally more expensive for everyone. Governments, companies.
Eventually consumers too, through mortgages, car loans, everything. The era of super cheap money, the zero-rate free lunch, it's definitively over, even if central banks cut short-term rates later.
That long-term cost of money is staying higher because of government debt risk.
That seems to be the IMF's core message on that front.
Okay, before we dive into the specific vulnerabilities the IMF flags, there was this weird thing happening with the US dollar recently.
Ah, yes, the decoupling.
Yeah, for ages, the rule was U.S. interest rates go up relative to other countries, the dollar gets stronger. Simple.
Textbook stuff.
But recently, the dollar actually weakened quite a bit, like 10% against major currencies, even though U.S. rates were still much higher than, say, Europe or Japan. What was driving that?
It's a really interesting case study in market behavior, sort of trumping fundamentals. The GFSR points to a massive, sudden rush to currency hedge.
A rush to hedge. Explain that.
Okay, so think about all the non-U.S. investors around the world. Big pension funds, asset managers, even foreign central banks who hold trillions of dollars worth of U.S. assets, mostly stocks and bonds.
And often, they don't hedge the currency risk.
Yeah.
They just hold the dollar assets.
Historically, a lot of it was unhedged. But as the dollar started showing just the first hints of weakening earlier this year,
People got nervous.
they panicked. They rushed to buy protection to hedge their dollar exposure, basically selling dollars forward to lock in the current exchange rate and avoid further losses if the dollar kept falling.
So the act of everyone trying to hedge at the same time actually caused the dollar to fall further. It became a self-fulfilling cycle.
That's exactly the mechanism the report describes. Massive hedging demand equals massive dollar selling pressure, accelerating the decline.
Wow. And is that risk over now?
Well, the report notes something interesting. They calculate the optimal currency hedge ratio, basically, how much hedging you'd need to minimize the volatility of your total returns.
And then?
And that optimal ratio has actually gone up recently, which suggests that even after that rush, global investors are probably still underhedged compared to what the models say would be ideal right now.
Meaning if the dollar starts weakening again, or even just gets volatile.
You could see another wave of forced hedging, another big rush for the exits, acting as this huge hidden risk amplifier in the FX market.
Okay, so that sets the stage beautifully. We've got stretched stocks, government debt pushing up long-term rates, nervous dollar holders. Now let's get into the really deep structural issues. The IMF points to 4 specific fault lines beneath the calm.
Right, 4 core vulnerabilities. And the first one hits right at the heart of the system, the U.S. Treasury market itself.
The bedrock. What's wrong with treasuries? Aren't they the ultimate safe asset?
That's the perception, but the IMF warns that sovereign bond markets generally, and Treasury specifically, are on, quote, shakier footing than they appear.
Shakier footing? How?
One key sign is this concept of eroding convenience yields.
Okay, we talked about term premia, the pay you get for risk. What's the convenience yield?
Convenience yield is like the opposite. It's the premium investors are willing to effectively pay by accepting a slightly lower yield just for the privilege of holding an asset because it's super useful.
And for treasuries, that usefulness is
Unmatched liquidity, you can always buy or sell them easily. Their use as the best collateral in repo markets and for derivatives. Their role as the global risk-free benchmark. That's the convenience.
So if that yield is eroding, it means investors are valuing that special utility less.
Exactly. It happens when the supply of treasuries mushrooms because of huge government deficits flooding the market. Or, more worryingly, it happens when the market starts to suspect that maybe, just maybe, treasuries won't be quite as liquid or risk-free under extreme stress as everyone assumed.
And what makes the treasury market particularly fragile now, according to the report?
It's the deep, deep interconnections with the non-bank financial intermediaries, the NBFIs, the whole shadow banking world.
Right, the hedge funds, the big bond mutual funds.
Exactly. These NBFIs are massive players in the treasury market. They're not just buying and holding. They're using leverage, doing complex relative value trades like the cash futures basis trade.
Or just borrowing short-term to fund longer-term treasury holdings. Maturity transformation.
Yes, classic maturity transformation. Funding long-term assets with short-term liabilities that can be withdrawn quickly.
Which sets them up perfectly for a liquidity squeeze if rates jump and their investors all want their money back at once.
The classic run scenario. And the IMF actually modeled this specific nightmare.
What did the stress test look like?
They kept it conservative, but still severe. They combined really large fund outflows, think 99th percentile bad, like a massive panic, with a sudden, sharp interest rate shock, say 100 basis points or 1%.
Ouch. What happens then?
That double whammy hits the leveraged balance sheets of these NBFIs hard. It triggers huge margin calls. They're forced to sell assets to meet those calls. And what's the main asset they hold that's liquid?
Treasuries.
Treasuries. The model estimates these forced liquidations could potentially exceed $300 billion.
$300 billion.
Yeah.
In forced selling. Just that number. It should make policymakers everywhere pay attention. What does that kind of selling pressure do to the market?
It likely breaks it. That volume of forced sales would almost certainly overwhelm the capacity of the primary dealers, the big banks who are supposed to make markets.
Their ability to absorb that much selling is limited.
It's finite. They have capital constraints, risk limits. If they get swamped by sellers, they step back, liquidity vanishes, prices gap down violently, you get disorderly conditions.
Like the dash for cash in March 2020.
Similar, yeah. But the IMF makes a chilling point. They found that the market's tipping point, the stress level where yields suddenly gap higher, was actually reached earlier during the turmoil back in April 2025 than it was even in March 2020.
Meaning the system's ability to absorb shocks is actually getting worse. Its resilience is eroding.
That's the clear implication. The ground is getting shakier.
Okay, that leads us perfectly into the second core vulnerability. The NBFI web itself, this whole shadow banking sector.
It's just grown immense. We talked about the Treasury connection, but the scale is mind-boggling.
How big are we talking globally?
The global NBFI sector hit $239 trillion in assets. That was back in 2023 data.
$239 trillion. That's
Yeah.
what percentage of the total financial system?
Almost half. 49.1% of global financial assets, and its growth has just blown past traditional banking growth.
Wow, so nearly half the financial system is operating in this less regulated space. But the problem isn't just size, it's the hidden connections back to the regular banks, right?
That's the critical point. Banks are hugely exposed to NBFIs. The report pegs total exposures at around $4.5 trillion just for Europe and the U.S.
And a big chunk of that is direct loans.
Yeah, about $2.6 trillion are direct loans. So we didn't get rid of the risk post-2008. We just shuffled it into this NBFI box.
But that box is still bolted firmly onto the regulated banking system through trillions in loans and other exposures?
Exactly. The potential for contagion is massive. The report notes that some banks, especially the large U.S. regional banks, have really concentrated exposures to certain NBFIs, sometimes even exceeding their core Tier 1 capital.
That sounds incredibly risky.
It is. But maybe the more immediate systemic threat the IMF flags is the liquidity drawdown risk.
The liquidity lines, explain that.
NBFIs don't hold tons of cash. They rely on prearranged credit lines or liquidity lines, from their partner banks.
Yeah.
Think of them as giant emergency overdraft facilities.
So if the NBFIs get into trouble, say, from that treasury market shock we just discussed, or maybe losses in private credit,
They immediately turn to the banks and say, okay, we need that cash you promised us now. They draw down those committed lines.
and what does the IMF stress test show happens when they do that?
It shows potentially devastating capital hits for the banks providing those lines. In their conservative stress scenario, just assuming credit risk for NBFIs gets worse, triggering them to draw down all unused lines, the impact is severe.
How severe?
For European banks, half of them, representing nearly 40% of total assets, would see their core capital ratio, the CET1 ratio, fall by 100 basis points or more.
A full percentage point drop in capital? That's significant.
It is. And in the U.S., it's even more concentrated. Only 12% of banks take that big a hit, but those banks represent a whopping 67% of total U.S. banking assets.
So the risk is concentrated in the biggest, most systemically important U.S. banks, the ones you really don't want to see stumble.
Precisely. It shows how stress in the shadow banking system can directly and rapidly deplete capital in the core banking system through these hidden liquidity channels.
Okay, vulnerability 3 takes us into the brave new world of digital finance, stablecoin risk.
Yeah, these digital tokens, usually pegged one-to-one to the U.S. dollar, are marketed as safe, stable digital cash.
But the IMF sees a potential problem there, even though they're backed by supposedly safe assets.
They see a major potential amplifier of traditional financial instability. First off, the market is huge and growing incredibly fast. Projections are they could hit $2 trillion in market cap by 2028.
$2 trillion. And their stability relies entirely on what's backing them, right?
Entirely. And the reserves are mostly things we've already identified as potentially fragile. Short-term government bonds, especially T-bills, and commercial bank deposits.
So wait, stablecoins are basically just giant, largely unregulated money market funds.
That's a pretty good analogy, yes.
And they're holding the same assets, like treasuries, that the NBFIs are also heavily involved in and could be forced to sell.
That's exactly the systemic risk connection the IMF is worried about. It makes stablecoins highly susceptible to run risks.
A run on a stablecoin, how would that work?
If confidence in the issuer breaks, maybe there's a hack, maybe regulators raise concerns, maybe it's just caught up in a wider financial panic, users will rush to redeem their stablecoins for real dollars.
And to meet those redemptions, the issuer has to sell.
They're reserve assets. They're forced to dump treasuries, pull deposits from banks, potentially at the worst possible moment.
So just when NBFIs might be forced sellers of treasuries due to margin calls?
You could have stablecoin issuers also becoming massive forced sellers of the exact same assets, pouring fuel on the fire.
Creating this dangerous synchronicity, the digital asset world spilling instability back into the traditional system.
Precisely. Stablecoins look like a source of demand for safe assets in good times, but they can instantly flip into a huge source of forced selling pressure under stress.
And the report mentions another concern, especially for developing countries.
Yeah, a really important policy point for weaker economies. The easy availability of dollar-pegged stablecoins often flowing out from North America.
It lets citizens bypass their local currency.
It drives currency substitution. People start using the digital dollar for savings or even transactions instead of the domestic currency. And if that happens on a large scale,
It makes it harder for the local central bank to manage its own economy. It weakens monetary policy.
exactly, it reduces the effectiveness of their monetary policy transmission. It's a real sovereignty issue tied up in this new tech.
Okay, fourth and final vulnerability. This one focuses on the developing world again. Emerging market vulnerability, and specifically this thing called the sovereign bank nexus.
Right. And there's a split here. The big major emerging markets, think Brazil, India, Mexico, they've actually done a pretty good job over the last decade or two shifting their borrowing.
More borrowing in their own local currency.
Yeah, which makes them much more resilient to global shocks like swings in the US dollar or US interest rates.
But the smaller EMs, the frontier markets,
They're often still heavily reliant on borrowing in foreign currency, mostly dollars, which leaves them incredibly vulnerable.
vulnerable because if the dollar strengthens or U.S. rates rise, their debt burden just balloons in local currency terms.
Exactly. And for many of these weaker economies, the fundamental debt math is just brutal right now.
That's the math problem.
It's that their long-term real interest rate, The interest rate after inflation, which we call 12-year, is structurally higher than their long-term economic growth rate,
Sure.
$2.
Dollars is greater than JDLA? $2. Why is that so bad?
Because when the cost of your existing debt is growing faster than your economy's ability to generate revenue to pay it, your debt burden automatically increases over time, even if you run a balanced primary budget.
You can't just grow your way out of the debt.
Wow.
It mathematically keeps getting worse unless you make really painful cuts or raise taxes significantly.
Precisely. Painful fiscal consolidation becomes almost inevitable.
Okay, so that's the sovereign risk. How does it connect specifically to their banks? That's the nexus part.
The nexus comes because domestic banks in these countries have ended up holding a lot of their own government's local currency bonds.
Why do they do that? Is it forced on them?
Sometimes there's moral suasion, encouragement from the government, but often it's just because the yields look attractive or they need the bonds for liquidity management purposes. But whatever the reason, they hold a lot of this local government debt.
Which means the health of the banks becomes directly tied to the health of the government's finances.
Inextricably linked. If the government starts to struggle, if markets start worrying about a potential default or restructuring of that local currency debt.
It immediately hits the value of the assets sitting on the bank's balance sheets.
Exactly. And the IMF stress tested this specific link. They ran a simulation. What happens if there's a hypothetical domestic debt restructuring? Say the government imposes a 40% haircut, a loss, on the value of its local currency bonds held by the banks.
Okay, a 40% loss on those bond holdings. What's the impact on the banks?
It's devastating. In the simulation, more than half of the banking sectors they looked at would see their regulatory capital ratios plummet below the critical 10% minimum threshold.
More than half the banking system wiped out, essentially.
Falling below minimum capital levels, triggering an immediate domestic financial crisis, all stemming from that sovereign bank doom loop.
Wow. Okay, so we have these 4 deep vulnerabilities. The fragile treasury market intertwined with NBFIs, the sheer scale and hidden risks within the NBFI web itself, the potential for stablecoins to amplify stress, and this dangerous sovereign bank nexus in weaker economies.
It's quite a tapestry of potential failure points.
So now let's zoom out. How could this all interact? How does the IMF see this potentially breaking? Let's talk about segment 3, the systemic feedback loop.
Right, the GFSR doesn't just list the problems, it models how they could combine into a full-blown crisis. They lay out a plausible adverse scenario set notionally in 2026.
Important caveat. This isn't a forecast, right? It's a stress test designed to see where the system breaks under pressure.
Exactly. It's designed to expose the maximum fragility. The backdrop for their scenario is stagflation. So, weak growth and high inflation driven by, say, a flare-up in geopolitical tensions and maybe new supply chain disruptions.
Okay, stagflationary background. What's the specific trigger that kicks off the downward spiral in their model?
It's actually quite simple but powerful. They assume an across-the-board 10% tariff hike is imposed globally. Think trade wars erupting again.
Okay, 10% tariffs plus.
Plus, because inflation is proving sticky in this scenario, policy rates globally have to go up by another 1%, another 100 basis points.
That combination, tariffs plus higher rates, that shatters the market calm.
Instantly. That price for perfection complacency evaporates. Investor panic sets in.
And the first domino to fall in the financial system is?
Sovereign debt. Concerns about debt sustainability explode, especially for countries already on shaky ground. And that drives up term premia, the risk compensation, dramatically.
How much does term premia spike in the scenario?
By 300 to 500 basis points. A massive jump.
3 to 5 full percentage points added to long-term borrowing costs, almost overnight. What does that do to bond prices?
It causes them to collapse. Bond valuations plummet across the board.
And that collapse triggers?
Margin calls, massive margin calls on all those leveraged NBFI positions we talked about, especially the complex relative value trades or anyone funding long bonds with short money.
So this is where that $300 billion treasury liquidation risk becomes real.
Precisely. NBFIs are forced to sell assets into a falling market to meet margin calls. They dump treasuries.
And that forced selling plus the general spike in term premia
causes global financial conditions to tighten violently. It's a sudden stop in credit.
And the contagion spreads immediately.
Instantly. It spills into foreign exchange markets and emerging markets. Global uncertainty spikes. Everyone flees to perceived safety.
Capital rushes out of the EMs.
Yeah.
Especially the ones with that GDA problem.
They get hit hardest. Their currencies crumble. The report notes that EM currency bid-ask spreads widen by twice as much as in advanced economies. basically making it impossible to trade normally, liquidity just vanishes.
While this is happening in EM, what's happening back in the core banking systems?
They're getting hit from multiple sides now. First, huge valuation losses on their own bond portfolios because prices collapsed due to the term premium spike and the NBFI fire sales.
How big are those potential losses for banks?
The stress test suggests North American banks, for instance, could face a hit of up to 2.5 percentage points wiped off their CET1 capital ratio just from these valuation losses.
2.5% of core capital gone. That's huge.
It's massive. And at the exact same time, that other vulnerability kicks in, stablecoins.
The digital dollars. They don't stay stable in this scenario.
Not at all. Users panic. They see the chaos in traditional markets. Maybe they hear rumors about the reserves and they rush for the exits. Mass redemptions.
Forcing stablecoin issuers to sell their reserves.
The same T-bills and bank deposits that NBFIs are already dumping. So the stablecoin market, instead of being separate, becomes this powerful accelerator of the existing fire sale dynamics in traditional funding markets.
Driving prices down even further in a vicious spiral.
Exactly. It's a full, terrifying feedback loop. Policy shock leads to debt stress. Debt stress triggers NBFI liquidations. Liquidations hammer EM, cut bank losses, and trigger stablecoin runs, which amplify the liquidations.
And the ultimate impact. Does this stay contained within the financial system, or does it hit the real economy?
Oh, it hits the real economy hard. The sudden credit crunch and soaring refinancing costs hammer businesses. Corporate profitability gets crushed by the higher tariffs and the spike in interest rates.
How badly does it hit corporates in the model?
The scenario projects that, in some countries, a shocking 55% of corporate debt would fall below an interest coverage ratio of 1.
55%, meaning more than half of companies can't even cover their interest payments from their operating profits.
Exactly. That signifies widespread corporate distress, defaults, bankruptcies.
And that translates into
Layoffs. Companies slash jobs cut back on investment and spending. Consumer confidence collapses. Demand plunges. And that leads inevitably to a deep, synchronized global recession.
So the IMF paints this incredibly detailed picture of cascading failure to really underscore their main point.
Which is that the system's complexity itself is a major risk. Since the 2008 crisis, we've added layers of leverage, complex instruments, new players like NBFIs and stablecoins,
which increased interconnectedness.
Dramatically increased interconnectedness while simultaneously pushing a lot of the activity and risk outside the traditional regulatory spotlight.
So the big fear isn't that we learned nothing from 2008.
It's that maybe the fixes just pushed the fragility into darker, less understood corners of the financial system. We might have hidden the risk better rather than actually eliminating it.
The illusion of safety, created by complexity and opacity.
Right. And the core worry is that the next big shock might build up critical mass entirely within this massive, shadowy NBFI complex, and we won't see it coming in the regulated banking sector until it's already way too late.
Which brings us, finally, to the most important part. What needs to happen? If these are the risks, what are the solutions? Segment 4, policy prescriptions.
The IMF is quite clear and urgent here. They lay out 3 critical areas for action.
Okay, number 1.
Fiscal adjustment. This is probably the hardest politically, but maybe the most fundamental.
Governments need to get their debt under control.
Gently. The IMF argues decisive fiscal adjustments are crucial. Curb deficits, stabilize those debt trajectories, and ultimately protect the resilience of the sovereign bond markets that underpin everything.
Why the emphasis on urgency? Can't governments just, kick the can down the road? Maybe central banks can help manage the debt with more QE or something?
That's precisely the danger the IMF warns against. QE was arguably about addressing short-term liquidity issues. Sustained high debt levels, however, structurally raise long-term borrowing costs that term premia issue again.
So QE can't permanently fix a structural debt problem.
No. Policymakers need to implement ambitious but also credible fiscal plans. That means a realistic mix of spending cuts or rationalization and finding ways to raise revenue.
And that word credible is key. Markets have to believe the plan is real.
Absolutely. Because delaying action doesn't make the problem go away. It just means the eventual adjustment will have to be much sharper, much more painful, and potentially forced by a crisis.
And there's a trust element here too, right? Trust in institutions.
Hugely important. Sustained public trust in things like central bank independence, the rule of law, stable policymaking that's essential to maintain the safe asset status of core government bonds. If that trust erodes, if people start to fear political interference in monetary policy to fund deficits, that fiscal monetary nexus becomes toxic very quickly.
Okay, fiscal discipline is number one. What's the second major policy area?
Targeting the source of all that interconnectedness and hidden leverage. NBFI oversight and liquidity management. Time to shine a brighter light into the shadows.
So better regulation for the shadow banks. What does that look like specifically?
It starts with data, much better reporting requirements, better data collection, better analysis, and critically, much better coordination across borders.
Because these NBFIs operate globally, but regulation is often national.
Exactly. The risks are interconnected globally, but the oversight is often fragmented. Regulators need a clearer picture of the complex web of exposures across the entire NBFI sector.
And what about those investment funds that had the run risk in the stress test? How do you make them more stable?
Regulators need to push for wider adoption and better use of liquidity management tools, or LMTs.
Like what?
The key example the IMF often gives is swing pricing.
Swing pricing. How does that help prevent runs?
Okay, simply put, swing pricing adjusts the fund's share price, the net asset value, downwards when there are large outflows, or upwards when there are large inflows.
So the people running for the exit bear the cost of that exit.
Exactly. It makes the exiting investors absorb the transaction costs associated with selling assets quickly to meet their redemptions. This reduces that dangerous first mover advantage, the incentive to be the first one out the door during stress, making the fund inherently more stable.
Makes sense. And what about the banks that are connected to these NBFIs through loans and liquidity lines?
Supervisors need to be watching those connections like hawks, monitoring concentrated exposures, making sure banks have fully implemented robust standards like Basel III, and ensuring they have sufficient capital buffers.
Especially for those weak banks the report mentioned.
Yes, the IMF found that about 25% of global bank assets are still held by banks that look vulnerable under their adverse stress scenario. Those need particular attention.
Okay, fiscal NBFIs. The third area must be the new digital frontier.
Digital asset regulation, yeah. Specifically focusing on the risks from stablecoins.
The message here is basically regulate them properly.
Pretty much. The GFSR urges policymakers to move quickly to implement internationally agreed standards, like the ones developed by the Financial Stability Board, FSB. We need clarity and consistency.
What are the must-haves for stablecoin regulation? What absolutely needs to be addressed?
You need effective risk management frameworks for the issuers. You absolutely need clear, robust requirements for the reserve assets. What exactly backs the coin? How liquid must those assets be? How should they be audited?
So users know what they're actually holding.
Right. What happens if a major stablecoin issuer does collapse? How do you prevent the forced fire sale of its reserves from destabilizing traditional markets like treasuries or repo?
So it's about containing the potential fallout, preventing contagion back into the core financial system.
That's the core goal, bringing them inside the regulatory perimeter before they get even bigger.
Okay, this has been incredibly detailed and frankly a bit sobering, looking at all these risks. The IMF is laying out the fault lines, but it's not predicting doom.
No, definitely not predicting doom. It's providing actionable intelligence. It's a map of the risks that need managing.
So for you, our listener, trying to navigate this complex environment, what are the key takeaways? What are the pragmatic steps, the non-panic actions you can consider?
First, and most importantly, understand, don't panic. Knowing these risks exist isn't a reason to sell everything and hide. It's intelligence.
You now know where the potential stresses are: concentrated, stretched valuations, government debt pressure, that NBFI Treasury connection, stablecoins.
Right. And knowing that allows you to ask much smarter questions about your own financial situation, whether personal or for your business. How exposed am I to these specific risks?
Second point the IMF implicitly makes is about diversification, but maybe not just simple diversification.
Yeah, it needs to be thoughtful diversification. It's not just about spreading your money across different asset class labels.
What does thoughtful mean here?
It means really understanding how your different assets might behave together under severe stress, specifically under the kind of stress the IMF modeled.
So asking yourself or your advisor, Okay, what happens to my portfolio if term premia suddenly spikes by 400 basis points? What happens if there's a massive forced liquidation event driven by NBFIs?
Exactly. If the answer is, well, actually, pretty much everything I own goes down hard together in that scenario, then your diversification wasn't really resilient to the specific systemic risks the IMF is highlighting.
Okay, third takeaway.
Watch policy like a hawk. The trajectory of financial stability over the next few years will be heavily shaped by the policy choices made now.
Are governments actually going to get serious about fiscal adjustment? What new rules actually get implemented for NBFIs and stablecoins?
Exactly. Progress or lack thereof on those fronts will be crucial signals for future market stability and potential opportunities or dangers. The real battle isn't fought in quarterly earnings, it's fought in the policy decisions around debt and regulation.
And finally,
Get curious. Don't be intimidated by the complexity. Instead of fearing the shifting ground, become a little obsessed with understanding the connections.
ask the hard questions. What are my real exposures? How resilient is my own financial setup? What could policymakers be doing better?
It's about engaging with these issues. The system is definitely under stress. The IMF makes that clear. But this report gives us a map of those fault lines.
And maybe one final thought to leave people with. Something that really underscores this idea of shifting ground.
Yeah, there's a fascinating point buried in the discussion about convenience yields we had earlier.
The eroding trust in the ultimate safe asset.
Exactly. The report explicitly states that the cross-border convenience yield for U.S. Treasuries, how much extra value global investors place on them compared to, say, German bunds or UK gilts, has seen a secular long-term erosion over the past decade.
So this isn't just a recent blip, it's a slow-motion trend.
It's a slow structural decline. It suggests that global investors, quietly, have been gradually diversifying away from relying solely on the U.S. Treasury as the ultimate safe haven for years now.
Regardless of the short-term market calm.
Regardless, this slow erosion of perceived safety, this gradual decline in the unique status of the very foundation of the global financial system, that perhaps is the deepest, most profound shift happening beneath the calm we see today.
The ground is definitely shifting. We've helped map the fault lines for you. Now you know where to focus your attention. Thank you for joining us for the deep dive.